Hey everybody, thanks for joining us. Welcome to the next ticker tape educational presentation on 6 keys to making a successful investment in a private deal. My name is Tom Schmidt. Happy to be here, and we're going to run through a series of educational slides to also talk a little bit about ticker tape investments and some of the deals that we have done and that we are doing. Quick disclaimer. This is not an offer to sell securities by any of the companies mentioned today, Ticker Tape Investments, Gallagher Partners, Utility Rescue, none of those. This is just a educational presentation to talk about things that we've learned over the years while investing in private deals. There are always risks associated with any investment, and we do not give legal advice, investment advice, or other professional advice. You should get your own advisors to advise you on any deal you look at. I get asked the question all the time, what is ticker tape investments? Well, it's not really a business. It is a loose affiliation of a group of investors that invest in deals together. Rita and I lead the group, and we tend to go out and find investment opportunities that we want to deploy our own capital in, and then we bring in other investors to invest alongside us. Why? Well, the primary reason is that if I can make larger investments when, say, I want to buy SoFi stock, that gets me access to deals that I wouldn't get access to as Tom Schmidt, small investor. And so having the group Ticker Tape Investments gives us the ability to negotiate, gives us better access, all those kinds of things. And it lets us do more deals. It allows me to spread my limited capital across a larger portfolio of investments. All these little logos you can see on the screen are deals we've done in the past, from Palantir and SoFi to Kraken and Ripple to USA Rare Earth, a mining company, Impossible Foods, plant-based meat products, ThoughtSpot, an artificial intelligence database searching system. Harder to get pictures of the real estate deals we've done, but lots of multifamily, hotels, a litigation funding investment, etc. We have currently four open deals. One is TTI debt, one is another multifamily investment. The third is TTI Metaverse, where we invest in cryptocurrencies, real estate in the metaverse, blockchain software deals, Web3 gaming deals, that sort of thing. And last but not least, you probably have heard about the utility rescue offering. So we have TTI Utility Rescue open as well. We've had numerous exits. I'm going to talk about some of them in a minute. Various deals that either went public or liquidated, and we received a return of our investment. This is a sampling of some of those. We have the ones that are gray have actually concluded and liquidated. The ones that are in green are expected to liquidate. For instance, 3M, the litigation funding deal, has settled. It's just a matter of claimants being paid out their settlements, and so we're just waiting on the timing for the funds to be distributed. USA Rare Earth has also announced a SPAC deal. They are going public, and sometime, we don't know the date yet, but sometime between the end of January and April, we should receive a significant return on our USA Rare Earth investment. Current, how do you say, conventional wisdom is that that's going to be about 3.1 times our money. Nice little return. The stock of the SPAC has been running up a little bit in recent days, recent weeks. So we're kind of holding our breath, hoping maybe we even get up into the 4 range for that one. So far, our best deal has been SoFi at about 4.8 times our money. And so we're looking for, when you think about investment opportunities, we're not looking for deals that are going to make us 12% or 15% or anything like that over time. We're looking for a multiple of our capital. Just like you may have seen the utility rescue deal, we're projecting a nine times return for investors that get in this round at this low share price. Even like our multifamily deals, We're looking for a consistent yield. Same thing with like a surgery center or an emergency room deal. We're looking for consistent cash flow on a quarterly basis, but then still some sort of multiple of our equity at exit. Typically, sort of a minimum of 2 times our invested cash. As I said, 4 deals open and they're very different. They fit different profiles. If you're interested in one of these, reach out to Rita. She can get you all the information for any of the deals. But they have different, risk return profiles. The debt deal, sort of lowest risk, only going to pay out about 12% per year over time, pretty consistently. But there's no upside to it. You're just getting, your cash back plus about 12% per year. A little more risk in a multifamily deal, looking for like a 30% IRR minimum, or I should say, we look for projected 30% IRR minimum. We're really looking for the deals where there's some sort of explanation of why we're going to double our money plus get that sort of probably 8 to 14% annual cash return. Metaverse holdings, much greater potential upside, but also much, much riskier. We're buying early stage cryptocurrencies. We fully expect many of those to go to zero. And so we're looking for the handful that have high performance to generate a multiple of our capital. Here we're talking, if over the long term this thing doesn't return 10 to 15 times our money, it'll be viewed as a failure because of the sort of higher risk deals that we're taking. And of course, obviously the potential upside of these early stage cryptocurrencies, the real estate in the metaverse, Web3 gaming, where that means you're playing a video game and getting paid to play the game. So kind of a hot new thing in the video game world, especially outside the United States. And then last but not least, utility rescue is looking at a 900% estimated return because it's a pre-IPO deal, and now's kind of a sweet spot to get into that opportunity. We'll talk a little bit about some of those today as I go through the 6 keys to a good investment. But if you want detailed information on the opportunities, just reach out to Rita. Who is it at Ticker Tape? Well, from a driving seat standpoint, it's just the two of us, Rita and I, but we represent about 300 investors that invest alongside us in all these different deals. And we're not like a 2-person show, right? We enlist the help of those 300 investors to A, bring us deals, find deals for us, B, help us vet the deals, look at them, hey, do you have experience in mining? Okay, we're looking at rare earth or USA rare earth. Come take a look at it and tell us what you think about the opportunity. And so we leverage that group for more than just the capital, for the expertise, for the deal flow, etc. My background, I'm a lawyer. I am an entrepreneur and an investor. I think Utility Rescue is my 17th company that I've either founded or co-founded over the years. So I've been around that block a few times. About 12 years ago now, somewhere around there, depending upon how you count, I started actively investing in private equity deals and started Ticker Tape Investments in 2014. Been a successful litigator. That's kind of how I got into all this. I started representing investors who've been cheated in deals. So the slides I'm about to talk about in a minute, much of that information I learned from litigating investor fraud cases and finding ways that bad people have cheated investors out of their money. And so one of the things I talk a lot about is how can you, what sort of warning signs should you look for? How can you avoid some of those pitfalls? Rita has has a 30+ year track record in the investment space, started as a trader on the floor of the Chicago Merc, and has raised hundreds of millions of dollars of capital for all kinds of different industries, and has kind of a niche expertise in PR, marketing, in big media, whether it be radio, TV, online, etc. And so plays a key role in helping our portfolio companies do marketing as well as advising us on the due diligence side in that regard. So Without further ado, let's talk about 6 keys to making a successful investment in a private deal. And again, I could tell you about 30 of these, but we've boiled this down to the 6 that we think are kind of the most valuable points to make sure that when you're looking at a potential investment in a privately held business, whether it's a house, a multifamily deal, some sort of real estate syndication, a pre-IPO deal, a startup company, any kind of privately held investment, you want to make sure that you can check as many of these 6 boxes as possible. First, make sure that whoever's promoting the deal has skin in the game, meaning they have invested their cash. I do not mean that they own some stock in the deal. It's not about will they get an upside if it is successful. It is about will they suffer pain if it fails. That's what you want to make sure of. Number 2, are the dogs eating the dog food? That was one of the first things one of my investor mentors taught me. Make sure that the company's product, whatever that may be, could be a service, is gregariously consumed by its customers, right? People need it, want it, or clamoring to get it. That's the kind of deal you're looking for. Is the company well funded? We'll talk a little bit about that. Number 4 is a big one. I'm going to give you a couple of examples when we talk about this in more details from my litigation career. But there's a lot of deals out there, particularly a lot of these Reg A plus deals that I see out there where they're not as well vetted and you have less sophisticated investors looking at them. There's a lot of ways that the people putting a deal together can take advantage of investors. You know, my doctor clients, my dentist clients, all these folks have challenges where they don't know what to look for. So number 1, it'd be helpful if you can hire an advisor to help you look at a deal. But if not, then start attending these events with ticker tape and we'll educate you on some of the stuff to look at. But make sure that the deal is favorable to your class of investor, not some investor that came in earlier. Number 5, make sure the management team has experience. There's some components to that that you may not have thought of that we'll talk about in a minute. And last, I like to talk about a particular business as efficient. And I don't really mean by that you're hoping that the business runs well and makes money. What I mean is the more efficient that the business is as a business model, the more mistakes that can be made, the more bad things can happen in the economy that hurt the company, but it still survives because it has what I call room for error, right? That's a key thing. So we'll talk about that a little more. Number 1, make sure that whoever is asking you to invest, could be the founder of a startup, could be the CEO who's been hired to come run a company, could be if somebody's doing a real estate syndication, it could be the property manager, whoever's asking you to invest. If they have not put cash in the deal, I will not invest in it. Let me say that again. If they've not put cash, their own dollar bills, into the deal at the same risk as me, I'm not investing in the deal. I've seen hundreds of opportunities. I'm sure many of you guys have too, where the founders are, well, the 5 of us were making 300 grand a year before, but we're only charging the company 200 grand a year. So we're getting credit for a $100,000 a year investment. That is not an investment. That's me paying you a salary out of my pocket and you getting stock anyway. Not okay. If you're not putting your cash in the deal, now it doesn't have to be a lot, but it needs to be a lot in proportion to their net worth. And the reason is not because people think, oh, I want the management team or the insiders or the founders to quote have stock because we want them to be motivated to have success. That's important, but that is not nearly as important as what happens if the deal fails. I took that little graphic and used it here because I think it's perfect. It's a little gruesome, but the idea is that, hey, we're going to take off like a rocket. And if the rocket explodes, I want the founder to explode with it. I want her to be super motivated not to let it fail. Some of y'all have heard me tell my story. I heard this on the radio one day and I literally like stopped in my tracks. I was so fascinated by this little vignette. Supposedly, somebody asked Jimmy Carter, former president, one time, what is the difference between communism and capitalism? And his answer was, a farmer in the Soviet Union will not stay up all night with the state's pig. I was like, what the heck does that mean? And what he explained was that if you're a farmer in communist Soviet Russia and your pig got sick, you let the pig die. And the next day, or maybe the day after, a truck shows up at your farm and drops off another pig. That pig belongs to the state, to the government, not to you. However, in Iowa, that pig represents that farmer's daughter getting food, getting to go to the school trip, getting new shoes, all those things. So if a pig in Iowa gets sick, the farmer and probably the farmer's wife and kids are up all night in the barn nursing that pig back to health. That's the pig you want to invest in, right? The one where the farmer is so motivated, he'll stay up all night if he has to. He will work night and day tirelessly because if it fails, he will suffer. That's what we're looking for. Ask these questions. Get on a call, talk to the founder, whoever's asking you to put money in. Don't be shy. Ask them, tell me, hey, if this business fails, I want to hear how, what kind of pain are you going to incur? Now, sometimes I've been in this situation as an entrepreneur. Once upon a time, my company was doing a couple $1 million a year in sales, and all of it was on a credit card merchant processing account, and I was personally liable for all of those sales. So in other words, if people buy tickets, this was Onboard Tours, we'll talk about it a couple times, give you all a couple of examples. So if Onboard Tours sells tickets today for July, but then the company goes out of business in March, that money has to be refunded from the Onboard bank account. If Onboard doesn't have any money, the merchant processing company is coming to Tom Schmidt. And so I would have been devastated if that had happened financially. And certainly it was roughly equal to at some points in time, it was roughly equal to about my net worth. So it would have literally wiped me out over and above the money that I had invested in the company directly. And so, that's not nothing, right? You want that guy or those guys or gals motivated to make sure that the company survives and succeeds. You want them to be in that position. Hey, we bought trucks. Did you guarantee the loans? Hey, what happens if we don't pay these bills? Are you liable for any of these? How much cash have you put in versus kind of what's your net worth? Is that a lot of money to you? But what we're really looking for is we want them motivated not to fail. That's the key thing. Second key, the dogs are eating the dog food. I'm looking for investments where the dogs are already, I should put the word already in there, eating the dog food, okay? Now, I don't invest, Ticker Tape doesn't invest in companies that are pre-sales. In other words, they haven't sold anything yet. And this is the reason why, this key, is that I don't want to make a bet on whether or not the dogs will eat the dog food. What do I mean by that? Again, these are not my words. This was one of my mentors, Jim Alexander. I'll tell you a couple stories about him later on. Told me this. He said, don't invest in a early stage company unless you're certain that the dogs will eat the dog food. And I'm like, what does that mean? He said, well, what happens is, he goes, I can create a wonderful dog food. I can, tell you how healthy it is. I can tell you how it's going to make your dog live longer. It's going to make your dog's coat look shiny. And I can probably market it in a way that people will buy it. But if people buy a bag of my dog food and take it home and the dog won't eat it because it tastes bad, they're never buying a second bag and my company will fail, right? So you want to know that the product, whoever the end user is, which may or may not be the customer, obviously in the case of the dog's owner is the customer, but the dog is the end user, make sure that the end users love it. So I wait until I'll invest later when I can see whether people are clamoring for the food. And by the way, very cute photo, but what's wrong with that picture? I'll tell you what's wrong. If you got a bowl of dog food in front of two puppies and their heads aren't buried inside the bowl chomping down, they don't love it, right? Dogs are aggressive eaters because they're wired to think that if I don't eat it right now, someone's going to take it away from me. And so I want the ones where they're voraciously consuming the product. Make sure you find a business that's already proven that its product works. One of the words I like to think about is rabid fans, right? Sorry with the continued animal analogy, but I'm looking for businesses that have rabid fans, people that love the product, they love the company, they're ready, willing, and able, and clamoring to buy more of it. A great example of this is utility rescue. If you ask Rita, if you're talking to her about investing in utility rescue, say, Rita, tell me about the dog eating the dog food. Well, the company has 80,000 existing customers who freaking love the company. Why? Not because we're great or we have good people or we are nice. It's because literally all the company does is save people money, right? So when it's saving you money on your cell phone bill and you get that notice saying, man, I just saved $800. I was going to pay to Verizon. Now I don't have to. Holy cow, you love utility rescue, right? So just had a meeting yesterday with a restaurant chain called Hot Dottie, and the CEO's like, where do we sign? He goes, wait, you're telling me you're gonna go negotiate our monthly bills, including garbage pickup and internet service and electricity and all these things, and we only pay you if you save us money? Where do I sign? You can sign with 50 restaurants. So that's the kind of deal I'm looking for, where I know that the product works, people love the product, it has value, people will pay for it, etc. Another thing, now remember, how's this going to play out? You're going to ask the promoters, hey, I need to know if the dogs are eating the dog food. How do you do that? Show me your sales. Well, I've litigated cases where people manipulate the sales reports to make it look like they're doing better than they are. So make sure you take into account things like cyclicality, right? Hey, you showed me the last 12 months, and I happen to know that the economy's been very strong the last 12 months in this area. Show me what you were doing 4 years ago when the economy wasn't so great. How'd you do during COVID? How'd you do during, if it's been around long enough, how'd you do during the Great Recession, right? I want to see what is the impact on a recession of a recession on your sales, because remember, you're investing today, but today's economic climate may not be the same next year, and you may lose your investment because it turns out the economy goes down and they fail. You want to understand cyclicality. You want to understand seasonality. I put on here onboard tours. Again, this is one of my companies that we ran years ago that did sightseeing tours. And so, of course, we never did this. But what I could have done is I could have had investors like investing in, let's just say, September, and show them 5 months of sales and be like, see, look how much our sales, or even show them 12 months of sales and say, look how much our sales have grown over the last 12 months. Well, that's purely seasonal. If you took a 12-month graph of any time period during the whatever 10 years, 16, 15 years, I think the company was around, any 2-year period, you would have seen a huge increase in sales in the summer and then a decline, and a slight increase in December, and then a massive decline in the winter, and then an increase in the summer. So don't be fooled by that. Take seasonality into account. Another example is Marble Slab Ice Cream. I represented a bunch of Marble Slab franchisees who went and looked at the company, said, man, these sales look great. They bought a franchise and they failed. What happened? Well, anything like a restaurant or a new retail store tends to have that kind of trendy newness factor, right? New restaurant opens up, tons of people go there to try it out. A bunch of them are like, it was all right, not my favorite, and they never go back. What's the one? There's a fried chicken franchise from Guatemala called Pollo Campero, and I was involved in some lawsuits around their expansion into Texas. Well, I mean, this is not an example of something bad, but when a new Pollo Campero restaurant opened up in Houston, Texas, it looked like a In-N-Out burger. There'd be 40, 50 people standing outside the building in line trying to get this fried chicken. And it was because there was all this pent up demand that was finally satisfied. All these people that had moved to Texas from Guatemala or maybe Honduras nearby and knew about it. They were like, oh my gosh, we got to go get this. And then 6 months later, those lines were gone. And so make sure you take into account when you're looking at sales, it doesn't mean that the dogs like the dog food, that they sold a bunch in the first 3 months. The question is, Did those people come back and buy it again? You're interested in repeat business, longevity of business, uh, limited impact to cyclicality, etc. And also always ask yourself, are there other factors that I'm not taking into account that affect the sales? Number three, cash, right? So we want to make sure we're investing in a business where cash, and I try to use these words carefully, where cash is not a problem. What does that mean? Doesn't necessarily mean that the company has a lot of cash, but you want to make sure that after you invest, there's probably a use of proceeds. When you give your 100 grand to the company, they're going to use that money for something. You need to make sure that they have a plan that is very credible and likely to succeed to generate more cash, right? One of the things, I talk about deal risk versus financial risk versus other kinds of risk, fraud risk, et cetera. But here, you look at a deal, you're like, man, I love the apartment complex. It looks great. It's in a great neighborhood. I see all these things. But if the promoter can't get a loan to do the purchase, they're going to spend your investment on pre-deal due diligence and lose your money and never buy the complex. Or if they're unable to raise additional capital when the bank calls and says, hey, the economy's gone sour or interest rates have changed, we need you to put more equity into the property, they can get foreclosed on if they're not able to raise additional capital. So you want to know the founders, the people running the business, how are they going to get capital? Maybe they already have $3 million in the bank and you're the next 100 grand. That's the kind of situation where you don't have to worry as much about it. One of the things I always talk about is be the last one in the round, not necessarily the last investor in the company, but if the company says, hey, we're trying to raise $5 million to do X, I would not want to be the first, I would not want to invest after they've raised, say, $300,000. I would want to make sure that my investment is part of sort of closing out the round. Doesn't have to be the last one in the round, but as close as you can get to that, to make sure that the company is not going to need additional capital. Now, here's a quick example of this with utility rescue again. So right now, utility rescue, I think this is our third type of investment round we've done. We started with preferred shares equity raise, then we did a common stock sale. Now we're doing a convertible note that converts into common stock. And the stated maximum of the convertible note is $5 million. And we're only just under $1 million raised out of that 5 million. So someone might look at that and say, oh, I don't want to invest right now because I want to be closer to the 5 million. Well, what's happening with utility rescue is we're going to close that round down early. In fact, I think I got to have some more conversations with the team. But in light of the recent conversations that we've had with these restaurant companies, I think we're going to announce it before Christmas that we're closing this round down because of the $2 share price, and then we'll launch a new round at a higher share price. So that's the kind of thing you want to be looking for. Not necessarily that you're the 4.9 millionth dollar in, but that the round, you want to be at the end of the round and the company's moving forward with some other activity or some other action, and there's an expectation that they'll be able to bring in additional capital. What else is on here? Oh, another big deal that will, if you follow this rule, you'll miss out on some investments, but the ones you make have a statistically higher chance of being successful. And that is how does the management team or the people in charge handle other people's money? All right. So things like, are they flying first class when they're traveling around and charging the company? Are they leasing a Mercedes and charging it to the company? Are they buying expensive meals when they do client entertainment? Are they going to Ruth's Chris or are they going to Olive Garden, right? And what ends up happening is a lot of people that are entrepreneurial are of the mindset, hey, listen, our investors want us to be impressing our clients. We need to go to Ruth's Chris Steakhouse, and we need to be, when we take our managers out, even for internal meetings, we need to go to fancy places and stay at the Four Seasons and do these things because we need to look like we're successful. BS. I don't buy that for 1 second. I mentioned my old mentor, Jim Alexander. Love the man dearly. Rest his soul. He is mostly responsible for me being able to have the confidence to transition from being a lawyer to an entrepreneur. He taught me a ton of stuff, took me all over the world, to Brazil, to Ecuador, to Mexico. But one of the things I never agreed with him on was he believed in this spending money to look like he was important and the company was successful. And I saw it as, that's not your money, that's the investor's money. You need to be more conservative with it. And so watch for that. Ask them, hey, when you travel, tell me the last 3 hotels you stayed in. And if they say Four Seasons, Ritz-Carlton, and JW Marriott, I would think about backing away, because probably they're not good stewards of other people's money. Same thing with Coach. Now, for me personally, in my personal life, I stay in fancy hotels. I get suites. I fly first class, all these things. But what I do for the business is either I fly coach and stay at a low end hotel, or I either pay for the flight or the hotel, or I subsidize it. And oftentimes what I'll do is I'll buy the coach plane ticket, and then I'll use my personal frequent flyer miles to upgrade to first class if I don't automatically get a preferred upgrade or something. But make sure what matters is not really whether the guy's flying first class, but rather who's paying for it, right? So make sure that the people that you're trusting with your money care about the fact that it's your money and not just spending it willy-nilly. Number 4, this is the hardest one for non-lawyers in particular to understand, but to me it's one of the most important. One of the first shareholder cases I ever handled was in bankruptcy court in Houston, Texas, and I actually tried the case and had the judge she entered a judgment for my clients on something called shareholder oppression, which was not even a cause of action in Texas at the time. It's since been disavowed by the Texas Supreme Court in other cases, but my clients won. And what we were saying was, you are taking advantage of us as shareholders. And what happened was, in that deal, they went to this doctor and said, please invest. He invested, I think, about $400,000, and they gave him a different class of shares than the ones that the founders owned. And come to find out, of course, he did this before he met me, come to find out, his shares didn't have voting rights. So when it came time to elect the board or make any decisions or sell the patent or all these things, the founder guys, who turned out to be crooks, were able to vote to do whatever they wanted. They didn't have to pay dividends to the shareholder. They didn't have to make decisions that were favorable to the shareholder. So if you hire me as your lawyer, for one thing, this is one of the number one things I'm going to focus on. I'm going to go through the bylaws or company agreement of the company and make sure that it is favorable to shareholders. And if they're not willing to change, first of all, I got to say this. If the documents that they already have in place are not favorable to outside shareholders, that is a red flag, right? I can go to them and say, hey, listen, my client is willing to invest, or Ticker Tape is willing to invest if you change these things. But what happens is, even if I get them to agree to change them, I've learned something about their mentality. Every deal that I've ever done where I'm a founder or have a vote, I guess you could say, in how the corporate structure is done, I make it as friendly for outside shareholders as I can. We always have preemptive rights, which means that an investor cannot be diluted without being given the opportunity to buy shares on the same terms as whoever the new guy is, right? Because you buy shares at $5 a share, and then the board can go, oh, we're going to sell 10 million shares at 50 cents, and all of a sudden your shares become worth nothing because you're a tiny fraction of the business. Make sure that you always have preemptive rights. To me, that's a deal breaker for any deal I look at. If we don't get preemptive rights, we're not investing. Same thing with cumulative voting for directors. So if you're buying a majority of the company as the investor, that's a different situation. But typically, Ticker Tape and my partners, we're buying a minority stake. And it's important that we have the right to cumulatively vote for board of directors. What that means is, instead of voting my shares for each of the seats, I can take all my shares and put them on one board seat, so that it increases the chances that I can affect a particular person being put on the board. In fact, most of the time, I'll demand that when we invest, we get to designate a director on the board. That is absolutely appropriate if you're making a significant investment, 500,000, a million, million five more, something like that. In say a $5 million round, you would definitely ask to have input. Say, listen, I want the right to appoint one member of the board of directors at all times. But certainly at a minimum, you want cumulative voting. You want to understand what is the job security of the founders. If we decide as shareholders or the board that they're not up to snuff, can we fire them with limited harm to the company? In other words, maybe they get a small bonus, maybe they get whatever bonus they've accrued up to that date gets paid. That's fine. But something like they get a bunch of stock, they get a huge 3 times their salary bonus, some sort of poison pill, watch out for those kind of things. That's a way that founders take advantage of investors. Now, I fall into the easy mistake of always talking in terms of like startup companies or standalone companies like Utility Rescue or Onboard Tours. A lot of you guys invest in these real estate syndications or ticker tapes in these healthcare deals where they're buying multiple emergency rooms. Typically, there is a promotional opportunity for the guys who put the deal together. They're earning fees from operating and running the business. And my comment on this is, of course, they deserve to be paid, right? If they're the guys driving the deal, they're staying up all night with the state's pig, if you will. They deserve to be paid. They deserve to get an upside. If they make you money, they should get more money. But I see these deals all the time that are way too lucrative for the founders. The guys who put in the cash, those are the ones that should get the lion's share of the reward. And again, what you want in a perfect deal, if you're talking about like a multifamily syndication deal, you want to have the promoter, the manager of the property, say, listen, the deal is so favorable to cash investors as opposed to the people doing the work that I'm putting more of my cash in on as a limited partner because I want to capture more of that upside on that side. You don't want them saying, oh, I don't need to put money in the deal because I'm going to get paid so much from the promotional side of it. And that's where I see guys lose all the time. They're like, wow, I invested in this apartment complex or this hospital or whatever the deal was. It was incredibly successful and they sold it. Man, that's great. And then when they get their distribution, they get like 40% return on their money. They're like, wait, I thought it was double and a half. Why am I only getting this? Well, the answer is because you signed an agreement that the promoters of the deal captured all the upside. So make sure that that is not the situation you're in. And again, guys, reach out to Rita. If you're looking at a deal and you have a question, feel free to reach out to us. We love seeing deals because it gives us kind of more data out there in the market. So we're happy to take a look at stuff, answer questions for you, et cetera, free of charge. So give us a shout if you run into these and you're just not sure, hey, is this fair or not fair? And we're happy to give you our opinion. Again, I know this is painful, but the right thing to do if you're investing your capital is to go through and read the company agreement or the bylaws or the shareholder agreement, whatever's applicable to the investment, and understand particularly what rights do you have, your class of shares, and what sort of benefits and upsides and inside deals do the founders get that literally is going to come out of your pocket. Right? If they're getting a percentage of profit, the investors are paying that directly to them. It's coming out of your pocket. Last thing I want to say, I want to emphasize this. I don't see it on this slide. Make sure that the class of shares that you're going to get is the same as the management team. Do not let the founders or even the earlier investors have preferred shares that have a particular component to them unless you're getting those same preferred shares. You want to make sure that you're in the same boat with the guys driving the boat, right? You don't want them to be able to cut you loose and they make money and you don't. That's what happened with my client in that first shareholder oppression case I did, where They gave him non-voting common shares, and they had, I think it was preferred member interests that allowed them to control the company to his exclusion. Make sure whatever shares you have, if they're in a different entity, God forbid, do not do that. Make sure you own the same class of shares in the same entity as the management team. It's okay if they have other classes, right? Just make sure that there's not somebody ahead of you, or that there's some big preference that someone else gets some sort of return before you get anything, or anything like that. Stay away from those kinds of deals. Number 5, track record. This one's pretty obvious, but there's some nuances to it as well. Number 1, make sure that the management team that's running the business has done this before. It's okay to invest in a startup or a business that's never existed before. That's all right. Make sure, though, that the management team has done it before, right? They've built a business to success. They've managed people. They've managed growth. Like, I had one not too long ago, a couple years ago. They're like, oh, we're raising money to grow the business. Okay, great. Well, tell me about the track record of the management team. What other companies have you guys scaled up? And they looked at me like I had a horn coming out of my head. I'm like, well, y'all have done growth capital offerings before, right? And you've suffered through the growing pains of a rapidly growing business, and you know how to. Nope, no idea. Okay, thank you very much. I'll go find a different one, right? I remember shaking my head. I don't know if y'all recall a few years ago, Krispy Kreme donuts had to file bankruptcy. And I'm thinking to myself, it might as well be crack cocaine. Like, these donuts are so freaking good. Everybody likes them. Why, for the love of Pete, would the company go belly up? And the answer is they grew too fast. They couldn't handle adding that many locations, managing that many locations, the cash flow challenges, all those things, and they got ahead of themselves and they failed. That's an inexperienced management team not knowing what would happen when they grew that fast, right? Don't fall for that. Another big one that I learned, again from one of my mentors, has the management team worked together in the past? Now, there's a couple ways this can manifest, but it's very important. Like, the venture capital and private equity firms will tell you this is one of the top factors in whether a business will be successful. If you can invest in a management team where the team is a bunch of friends that have done multiple deals together in the past and had successes and failures and stress and problems and gotten through it, that's worth its weight in gold. Because what always happens is 2 members of the management team start fighting, and all of a sudden you lose your CFO, or you lose your marketing person, or business development person, or something like that. And so you're looking for a management team. Obviously, the most important thing is that they work well together today. But a good indicator of whether that's true or not is, have they worked together in the past? The team at Utility Rescue is an example of this. The founding management team of Utility Rescue was the management team of Pulse Power. We started it from scratch, built it up, sold it to Shell, and then acquired Vive and started Utility Rescue. Several of those management team members have moved over to a sister company, Flagship Power, but we're all still involved. They're still aware of everything going on with Utility Rescue. And then the next layer management team, the midline managers, have been at the company for a long, long time. Some of them since, in the business since before the original company Vive started. So great track record. The management team works very well together, all that stuff. This little last paragraph thing is important, so make sure you read this and kind of internalize it. Having a good business model is almost never enough. You must have an experienced and agile management team that is able to react and adapt to crises, that is cool under pressure, that can maintain customer satisfaction and employee morale, and that can manage revenue and expenses, right? That if you write that down or print it on a placard and carry it with you every time you look at an investment opportunity, ask yourself, does this team meet up with those requirements? You're more likely to have success in your investment. 6th and last, is it an efficient business, right? There's different aspects of efficiency in relation to this key. Number 1, how scalable is the business? What is the cost of customer acquisition? The cost of getting a new customer is very important. I call a business inefficient if their cost of customer acquisition is too high. But again, set cost aside for a second. No matter what business you're in, it is really difficult to get clients in any business, in any way. I wish I had a nickel for every time I looked at an opportunity. They're like, oh, well, we're going to build this app and everybody that comes to Vegas is going to use it. And I said, well, wait, how are you going to get people, first of all, to hear about your app? Second of all, to download it. That's not an easy thing to get them to do. And then third, get them to use it more than once, right? And sure enough, I have one in particular. I downloaded their app when I was looking at the investment opportunity, and I've watched it decline. The content on the app is declining. It was amazing, this app. I mean, it showed you everything there was to do in Las Vegas. How many times have you been in a big resort, maybe a convention center or a casino hotel or a Gaylord resort or something, and you need a map of the building, inside the building. You need to know where's the conference room, where's the restaurant, where's the bathroom, where's where. They had maps of every location in Las Vegas, all the show tickets you could ever want, restaurant reviews, video reviews, all this stuff. The problem is not, it's pretty easy to build a business, pretty easy to build a mobile app if you have programmers. The problem is, how do you get customers to pick it up? And that's very, very difficult. And so this is where I encourage you to do a lot of due diligence. How are you going to get customers? How much is it going to cost? Can you scale? Will your advertising budget, which we can agree on how much is available, will it generate enough customers to generate enough revenue fast enough to give you positive cash flow? And then you get into, what are the marginal costs of the business? This is a big deal, right? As you grow rapidly, because obviously I'm not investing in your business unless you're going to grow the business quickly. As you grow rapidly, what's that going to do to your cash flow? Are you going to be a Facebook where they can grow to 1 billion users and not have a problem? Or are you going to be Krispy Kreme where they open too many locations and they fail? And so you need to understand that relationship. What does it cost? What are the burdens on the business of rapid growth? How are you going to be able to scale the business, et cetera? And then that is one piece. If you can confirm that the marginal costs are very high, and you can confirm that the business is profitable, the punchline, or what that adds up to, is room for error, right? The management team can make mistakes, because they're going to make mistakes. Stuff's going to go wrong. The economy's going to turn down. Interest rates are going to change. Occupancy is going to fall. If you have an apartment complex, the major employer nearby is going to decide to move to another city, and all your tenants are going to want to leave the complex. If there's profit and margin in the business, it gives a cushion. It gives the management team room to adapt and deal with those kinds of problems. Last, how do you weigh these factors, right? We talked about the 6 factors: skin in the game, dogs are eating dog food, plenty of cash, pro shareholder, an experienced team, and an efficient business. What if you only get 4 of those? What if 2 of those are no, right? Well, you can't do it as 6 check marks. You got to do it as a sliding scale, right? As I went through the presentation, I think I pointed out a few things where they're kind of like deal killers. Number one, if they have no money invested in the deal and they guaranteed some loan, I'm not investing. I want to see cash. If it's 10 grand and they convince me, hey, I only made $70,000 a year last year and I got a wife and 3 kids, and I got to support my mother-in-law. Okay, 10 grand is a big investment for that guy, right? So, but they gotta have cash in the game. Now, what if they put in 100 grand, but he made 600 grand a year for 5 years, and he hasn't guaranteed any debt or anything? Maybe even though he has cash in the game, I give him kind of a lower score for that factor. I got to take that into account. Maybe the dogs are preliminarily eating the dog food, but we've seen some signs of positive result there, but it's too early to really know for sure. Okay, that's not a deal killer. That doesn't mean I won't invest, but I'm already kind of paying attention. Maybe some of these other factors better be pretty strong to compensate for the fact that the dog's not or aren't yet eating all the dog food. Isn't a problem. Plenty of cash. Maybe they're early in the fundraising thing, but you kind of know, hey, markets are going pretty good right now. They seem to have a good program. The story sounds good. I think they'll be able to raise cash. That, by the way, there's another component to all this, which if you have a potential investment that meets all these and you're giving them a plus on all 6 categories, that would be the kind of thing that would tell you invest more money in the deal. If you're not sure about the factors, maybe you typically invest 100 grand in every deal you look at. Maybe you only put 25 in this one because I wasn't sure about whether they were going to be able to raise enough money. You can always invest in the next round, right? If it turns out they got the round funded, they got plenty of money, maybe you make a follow-on investment, even though you're paying a higher share price, you feel more confident about these keys. The shareholder stuff, again, there's some big deal killers in there for me. Preemptive rights is a huge one. Cumulative voting for directors, some sort of assurance that I'm going to have a voice in who's going to be on the board of directors is very important to me. Experienced team, if you told me they were all leaders in their various fields or areas of expertise, but they've never worked together, that doesn't mean I won't invest, but I'm going to need a little higher level of confidence at their ability to work together, get along, and not, be able to deal in stressful situations and survive and come out the other side. And obviously, the more efficient the business is, the less I have to worry about some of these other things, right? I don't need to worry as much about cash or whether the team has experience working together or whether the investors have as much skin in the game if the business itself is very profitable, has very low marginal cost. Like, for instance, give you an example of utility rescue again. So, again, we had this meeting yesterday. Hot Dottie says, hey, 50 restaurants are going to come online. Well, the first thing I think is, man, that's a lot of work. I'm going to need to engage a few more negotiators and auditors to help facilitate this. And our account manager person is going to be a lot busier for a couple months here. Are we going to be able to handle that? But at the end of the day, there is really no additional cost to us. It's third-party companies that are going to be doing the audits and the negotiating, so I don't have to worry about adding to my payroll. I have to worry a little bit about sort of the operational components of this growth, but there is no negative cash flow associated with this. It's not like I got to go buy widgets and manufacture them and then sell them and get the money later. I don't have to pay commissions. I don't have to pay the negotiators. I don't have to pay any of that cost until after I receive the fees from the client. So what that does is that puts our company in a very efficient position to be able to scale and grow rapidly because I can do it with positive cash flow transactions. And of course, these are enormous deals. I mean, we're going to be doing thousands of dollars of fees per year from these 50 restaurants. And so it's a huge win for the company, not necessarily just because we got a big sale, but because of the positive cash flow component of that sale, such that I can add it without adding additional cost, et cetera. And so that makes a really big difference in how the deal works for investors, how investors benefit from it, et cetera. All right, that's all I have for tonight. Hope everybody learned something, benefited from it, enjoyed it. Reach out to Rita Carpel if you have any questions. You can text her, as always, at 832-459-7335. Of course, you can also just reply to however you got an invitation to come to this presentation. So feel free to do that as well, and we're happy to answer any questions you have, look at any deals that you're pondering, and of course, if you're interested in getting involved with Ticker Tape, we'd love to have you join us. So give us a shout. Everybody have a great holiday and Happy New Year if we don't talk to you before then. Otherwise, we'll see you on the next call.